Thank you all for joining us for this Scale School event today. It's called Scaling Smart, Strategic Tax Planning for Growth, and that's hosted by Venture Lab and Lifelong Learning. I'm Lori Rosenkopf. I'm the Vice Dean of Entrepreneurship at Wharton, as well as the Simon and Midge Pally Professor. And I'm so thrilled to join you virtually today as we explore critical tax considerations that can really shape the trajectory of a scaling business. Today's program will be led by Professor Jennifer Blouin, and she's my amazing colleague and a leading tax expert who will break down the most pressing policy developments and what they mean for your companies. Jennifer will be joined by two esteemed panelists, Adnan Raza from Wharton's class of 2005 MBA, who's the CFO at PDF Solutions, Inc., and Howard Horn, Wharton MBA class of 2004, CFO and EVP of Corporate Strategy at Ultragenyx Pharmaceutical Incorporated. Now, here's how today's Scale School program will work. We'll start with introductions from Professor Blouin, and then there will be a discussion between Professor Blouin and the panelists, concluding with a Q&A. And you're welcome and encouraged to submit questions at any time. You'll see the Q&A button at the top right side of your screen, and if you don't see it, exit full screen mode. If you need closed captioning, click on the CC button in the bottom right corner of the video player. And with that, I'll turn the program over to Professor Jennifer Blouin.
Well, good morning and good afternoon to everybody. I think there's probably folks spread across the country. I hope all of you on the East Coast have dug out and are staying warm. So I'm delighted to be here today to talk a little bit about taxes and how it affects growth. I thought it would be best to effectively start with some notion of what's been going on in the policy circles. As many of you are aware, we've had some pretty significant legislative changes over the past 7 or 8 years, and one of which happened last summer, which was the One Big Beautiful Bill Act of 2025, or as I typically relate to it as OB3. So in general, we have had very business favorable initiatives that have come down the pipeline, particularly as part of this legislation. It essentially phased back in or removed the sunsets on a lot of very business friendly policies, including bonus depreciation, as well as, for those of you who are in conduit or pass-through form, favorable things along the line of 199A, qualifying business income, which allows you to exempt 20% of your income ultimately from taxation. We also had the extension or I guess permanence of the lower personal tax rate, which again also benefits conduit entities. It also removes some of the revenue raisers that were due to start on us from the TCJA, one of which I think is very salient to this group, which was the requirement that R&D, domestic R&D, be capitalized and then amortized over 5 years. Kind of the discussion back and forth about why would we want to hinder arguably one of the nation's greatest asset, which is our innovative activities. So unfortunately, however, if you do any international R&D, you are still subject to capitalization and ultimately a 15-year amortization. We've had a lot of changes on the international landscape as well, and I'll touch on that in a moment. But we've also settled some of our other benefits to intellectual property, and this would be something I call FDII, foreign derived intangible income. That rate was due to increase to 16.4%. We've now leveled it out at 14% in perpetuity. And again, this essentially creates a patent box or a favorable IP regime for those of you who are innovating in the United States. We have this tax, as I refer to it, formerly known as GILTI. This was our global minimum tax. So the United States, back in 2017, as we shifted to a worldwide system, put a global minimum tax in place that we termed this guilty. It was due to ratchet up to be up to 16.5%, but now it's also been legislated down to 14%, which makes us more competitive to what's been going on in the OECD. So again, this is something that will be of interest to those of you operating in an international scale. And finally, we've had interest limitations. Startups ultimately often have issues with losses. They also have issues with relatively light income. We had put a thin capitalization rule in place that ultimately then limited businesses' ability to deduct their interest as a function of what I will call tax EBIT or EBITDA. So this is tax computed earnings before interest and taxes. That had ultimately bit more firms because it would account for big deductions for things along the line of depreciation and amortization, which, see above point, is something that we specifically put in place to help incentivize capital expenditures. And so to have our interest be limited as a function of your deduction of those expenditures seemed somewhat nonsensical. And so they have fixed that. And now we have a relatively more favorable interest limitation. The last piece is just a couple mention on is the international landscape. I just wanted to announce for those of you who are interested in this area that about 3 weeks ago, we have finally gotten some certainty about how the rest of the world will be taxing the operations of US parented multinationals by negotiations with the OECD and other member nations. The United States and the OECD has agreed to something that we call the side-by-side agreement, which effectively recognizes the United States separate but equal minimum tax under that thing that I formally called guilty. And so now when US multinationals operate abroad, if they are paying guilty, they should be have a reduced impact of some of the what I will call the taxes that were put in place to help enforce this global country by country minimum tax. Now, how we got there is because the United States had threatened what we call a retaliatory tax for those jurisdictions that had something they called unfair tax practices, which was just a fancy way that of saying that they had adopted Pillar 2. But while this, I think, creates some certainty for US parented multinationals, unfortunately, I think this agreement has created much uncertainty for non-US parented multinationals. And then I think is a nice segue, hopefully, into the discussion that I will have with Adnan and Howard, just some concerns on the landscape of tax planning. We did not have tax reform for 31 years in the United States. Between 1986 and 2017. And now what we've seen is a number of policy initiatives that have been coming up and going away, depending on the administration in place. And that creation of this uncertainty leads to kind of a holdup problem about what firms should do when it comes to their innovation and investment policies in the United States. And I think we'll talk a little bit about that. Another issue is the complexity of the system. I don't think I need to probably tell anybody participating here today, as well as those of you watching, that the tax system has just become more and more complicated. I always like to point out is that the 2017 legislation was originally put in place for simplification. But if you look at the final bill and its explanation, it was over 1,000 pages. And so over time, we clearly aren't getting more and more easy. I think we're getting more and more complicated, and that's just compounded by the extent you do things abroad. Also, with respect to loss firms and sort of scaling up, is I think the provisions that we put in place from 2017 have actually disadvantaged those entities that are just coming out of a loss into profit. The reason is the interest limitations I talked about before are just merely a function of your profitability. They're not a function of actual amount of, say, debt in your capital structure. Furthermore, we set up rules that limit your ability to use NOLs dollar for dollar. So while it turns out to be more of perhaps the benefit from the government in terms of time value of money, right? You're going to get to use your losses. You just are pushing them out to the future. That could be very detrimental to a firm that is really trying to manage its cash flows, and whose cash flows are very critical to its continued survival. And so I would like to hopefully chat some point today a little bit more about thinking of getting to profitability and how the tax system ultimately helps us get there. Now, the last bullet point, I think, again, is the elephant in the room, is I like to focus on income taxes, but we have had increasing salience in non-income taxes for businesses. So I think we were just chatting offline about today's announcement of increasing tariffs associated with South Korea. The whole tariff landscape, something that used to be called customs duties, have become much more prevalent today as we deal with issues of negotiation in terms of coordinating an international regime. That said, we've also faced things like the VAT, the value added tax, which is something that the United States has been very reluctant to put in place, but frankly will help us a little bit with our I'll just say deficit spending. We have a little bit of a debt now in the United States that we do need to think about paying off. And then finally, I think some other non-income taxes, things that come back and forth over time, is the whole notion of wealth taxes. We can consider the California example and the billionaire taxes. That clearly is affecting business operations and the sourcing of business operations. And then there were things that the Europeans had threatened to do, which is put in place things along digital services taxes. All of these, while not income taxes, are very much part of the negotiation about setting optimal tax policy. So I think with that said, I hope that we can now begin a discussion between Adnan and Howard and get more of a perspective of those of you actually working in the field. Hi, welcome.
Thank you.
It's great to see you both. I just would like to begin first, if you could each briefly introduce yourselves. I know you've both been doing a number of things over the years, particularly since your time at Wharton, but I think having that introduction will give some context to those of us, to those participating today.
Sure, happy to go first. Thanks, Jennifer, and thanks, Howard. Good to see you again. First of all, delighted to be here. Anything associated with Wharton is a total pleasure, so thanks for the opportunity. Wharton class of 2005, as mentioned prior, and have been CFO at PDF Solutions, NASDAQ-listed public company now for 6 years. Did strategy and corporate development, helping grow a company internationally and domestically prior to that. Did investment banking and engineering for many years prior to that.
Hi, everybody. Howard Warren here, class of '04. Prior to business school, I spent a few years as an equity research analyst on Wall Street, researching life sciences companies. And after Wharton, I spent a decade as a consultant working with life sciences companies. And then had my first job in industry at Biogen, working in the finance department. And then from there, started a company on the West Coast called Vir Biotechnology, which was a true startup. There were 3 or 4 of us at the beginning, and we grew it over 6 years to 600. And now I'm in a mid-sized life sciences company called Ultragenics that works on rare diseases. And I'm CFO here now, too.
Well, fantastic. So while we're going to talk about, there's so many topics with respect to taxes that affect, businesses regardless of size or scale. I first wanted to ask one question to sort of set the tone of things that we can talk about is, are either of your organizations profitable right now?
For me, yes, we are profitable. Of course, there's a difference between GAAP and non-GAAP, and we are definitely non-GAAP profitable and have been from some time to time on the GAAP basis as well.
Yeah, we are not. Okay. Yeah, we are not profitable. We are on a pathway to become profitable. We've told the world we expect to do that in 2027. And for biotech companies, that's a pretty big deal. Only a fraction of biotechs ever kind of get there. So it's an exciting time.
So I guess, and so Adnan, were you always profitable since you worked with the organization, or have you guided that through the point where you begin to see?
Yeah, no, actually, when I joined about 6 years ago on a non-GAAP operating profit basis, we were not profitable. And the company has been around for 30 plus years. So back in the history, I'm sure those were the early days. But lately, we've made remarkable improvements over the last 5-6 years in terms of margins, in terms of profitability and growth. So it's been an exciting time to experience that profitability.
And so let me ask this question is, did you not think about taxes because you weren't profitable?
Good question. Contrary to what one might initially say, taxes are important even when you're not profitable. I think there's a lot of things that come into play. Naturally, a company is expecting to be profitable. So while you're in the stage where you're not, it's important to see where you're generating losses, where you're employing the people for future potential credits, and also where your IP is going to be located, again, for future benefits. So those are just some of the things. And if we were to have my tax experts on this call, they would list a litany of long reasons for why that is still important.
Howard.
Yeah, and I fully agree. Tax needs to be thought of from the get go. Even at Veerbio that I mentioned before, which was a startup, it's amazing how many decisions it helps inform. And our tax people at our current company have a seat at the table for all our key strategic decisions, whether that's R&D or decisions on supply chain or manufacturing or commercial or deals. The list is quite long. And if I had one comment that I would want everyone to take away from today, I think the key message is whether you're a small, U.S. only company or a larger international company, no matter what, you got to think about tax. It has implications, and make sure you get really smart tax advice.
Yeah. And I think this is, part of why I bring this up in the notion of profitability is a lot of folks sort of, my experience has been wanting to put that off, right? They're focusing on the business. And I absolutely agree. That's your primary focus. But getting good people to help support this function, I think, is critical, regardless of the stage that you're at. And so, again, it makes me feel important, and why people should take tax class is another reason why, a little bit of personal marketing. So in terms of the different stages that you've seen the firm and worked with the firm, and I think Adnan sort of alluded to some of these, which particular issues have been really salient? So take your number one. So I will start, Howard, this time, is what issue, first and foremost, was the first tax issue that you really felt like, wow, this is some knowledge and expertise that I need to consider in my business operations?
Yeah, I guess here's the way I've thought about it. Like if you're a U.S. company, I think property tax incentives is a place to start, and then you start thinking more about nexus, which is a fancy tax term that just says, do you have enough stuff going on that you should actually then get taxed? And so that's sort of a little bit of the initial stuff for domestic, and then for foreign, thinking about tax rate incentives if they exist, and then ultimately sort of permanent establishment, which is their version of sort of nexus outside of the U.S., and then what tax that leads to. And so those are kind of initial entry, sort of top of mind things that then lead you to things like, intercompany, transfer pricing, and then those types of arrangements. And then things go haywire and all crazy. And IP, by the way, is an important part of all of this too. But those are kind of initial top of mind things as you're getting them.
Yeah, so I'll bring up IP again, because I think we could probably talk an hour and a half merely on IP, right? Because of location decisions. But it sounds like it's not just, and again, I think that's an interesting point. It's not just income taxes, right? That property tax issue is something that as soon as you invest, you have to consider the property tax ramifications, because that's an immediate cash flow, unlike if you're a startup, right? Not an income tax, but ultimately an immediate cash flow in a non-income tax scenario. And so it sounds like when you're thinking about location decisions, first and foremost this is when the tax folks come in. And so, Adnan, I'd like your perspective on, a tax issue that brought, what was something that was really perhaps a surprise to you that you hadn't considered in making a location decision from a tax context?
I think if you were to ask any CFO with companies that have few hundred or 1,000 plus or larger set of employees, obviously we want to simplify the amount of work that our tax teams need to do. And one of the things we end up looking at is the point that Howard mentioned, which is nexus, which can be established by either if you have sales or even if you have some employees. So CFO's unfavorite list is the list of potentially all the locations where you just have one or two employees and don't have sales, yet have to deal with nexus issues just because you tripped up that condition. Analogous to that, when you're going abroad, you're initially starting with a smaller team. So then to think about when to establish a proper office versus to do consulting arrangements, that is another one. And the third one, in the direction of a lot of the stuff that we have been doing and I've done before, which is mergers and acquisitions, It's much like personal finances, that your to-do list grows longer and then you realize that you should really get to it. International entity consolidation, getting a quick handle on it, particularly after an acquisition, is one of the more important things. And as simple as that may sound in terms of, oh, it's getting some tax people in the room and sorting through it, it's actually a lot of people issues that you have to work through as to who will be the senior country managers and things like that. So my advice to anyone is to pay attention to those in the context of M&A as early as possible.
So I think M&A is something that you're effectively endowed with, however the target is established. But when you choose to say what I would do a greenfield investment, when you choose to place a toehold in a jurisdiction, what kind of tax things are you thinking about? Do they actually have sort of a direct impact, or is it something all indirect, kind of after the fact you consider these items?
Yeah, we had to deal with it, so I'm happy to go. And there are some jurisdictions, and you have to do an analysis of, again, what type of technology, where the customers are located, where you're going to be able to service them best. Because whether it's, even if it's R&D people, you are going to be needing to have them talk to the customer. So some time zone considerations come in. But after doing that initial analysis, you'll probably still have a choice of locations. And within that, your question becomes relevant. As in some R&D tax credits, there are jurisdictions that are quite favorable to that, where you can offset depending on the type of R&D, and every location has its own yardstick for what percentage of the compensation you may be paying to the employees. So there are definitely places where you can have a strong R&D presence, and in of themselves, the places are cheaper. Then you get the currency advantage. And then lastly, if you get the R&D tax credits as well, that's a huge plus. Those credits are important, but then you also have to, again, think about, you may not have income or revenue in those areas. So how are you going to monetize those taxes? And again, there are locations that allow you to defer those and carry those on for a long time, which become, again, favorable. So all of those factors, from where customers might want them to where R&D can be generated and kept for taxes to where I can postpone utilizing it later, play a role into where we might set up our R&D locations.
Yeah, I'd say ditto, and also manufacturing is another consideration of where those locations are. But yeah, everything Adnan said is relevant in the biotech world too.
So I'm curious, because there are some jurisdictions that literally offer holidays. I mean, I can think of Malaysia being an example where they've typically set out an olive branch and said, we will give you a very, very favorable regime if you're willing to park your activity here. And so does that influence, I think, Adnan and Howard, your list of places that you might consider? I mean, without knowing the details of your manufacturing, is it something that you would literally consider bifurcating certain activities in order to facilitate the tax benefits? Just to say, it clearly increases cash flows, right?
Howard, do you want to take that one?
I'll give you the broad answer, which is you got to run the numbers and do the analysis.
Yeah,
right?
exactly.
In our case, it's interesting because we're a rare disease company, so we're trying to create medicines to solve these diseases. So we're a little bit agnostic of what type of medicine. And so when you're thinking about manufacturing, like creating plants for each type gets really expensive. So we outsource a lot of that, and sometimes that's the right answer. Sometimes the right answer is to build a plant domestically. We actually have one in Massachusetts. That hasn't been such a bad thing under the current regime and Trump trying to bring manufacturing back into the US. And sometimes we think about doing things in Europe, et cetera. But I think ultimately you got to run the numbers and see how it plans out. And you brought up the uncertainty factor, like you can place a lot of bets and then the rules can change. With IP, the rules have changed pretty dramatically. I guess we'll get into that. But with tax planning, you're thinking about these super long horizons and you're putting a lot of money into things. You got to wonder, what if that changes in 2 years?
Right. No, it's a good point. I mean, I think that I cannot understate the significance of the uncertainty that we're inducing into the process by having this back and forth in terms of it's going to expire, it's going to sunset, it's permanent, and it will permanent for until the next administration. And I think that I am not envious of the position you're in terms of planning in that scenario. But let's talk about intellectual property. So this is where you do the R&D, ultimately assuming that you have the patent or the IP sourcing of that. And you know, I will put a little bit, and I know we've chatted again about this, is that it's complicated, and I'm sure that's what you're going to say, and the taxes only create that complexity. But I would ask, do you choose, even again, to do R&D abroad or in different jurisdictions because of the tax incentives, or is that just a side benefit of operating in certain jurisdictions? And again, whether or not that is, it's never, to me, abusive, the fact that there are jurisdictions that have created what I call an IP box or patent box that have been very, very favorable. The reason that they've done that is to attract the foreign direct investment. And so when you're sourcing your IP, do you ever consider these types of incentives, or is it a specific, everything's created in the United States and then it's more of an after fact that we transfer?
Yeah, I'm happy to go first this time. Look, the company started in the United States, so that's certainly how things evolved in the beginning. But as we become more international, today about half of our revenue is in the US and the rest is split over the world. It's important for us to realize and have these R&D centers and sometimes closer to our customers as well. I would say tax is a very important consideration, but just like we make any list of important things, it's one of the factors that we certainly consider. Tax incentives that other jurisdictions might offer, or the credits that we earlier talked about, play a key role. Naturally, later being able to, as I alluded to earlier, realize that the revenue in that jurisdiction to monetize those built up operating losses is another factor. But it's certainly an input. I would say it's not the only input. Nothing in business is the one and only kind of golden ticket, but it's certainly an important one that we consider.
So in biotech, IP is really critical, right? Because you get essentially your window to sell in a reasonably less competitive environment from your IP. And so if you're a domestic company, U.S. domestic company that's creating R&D or doing R&D here, in the past you would try to what is called cost share or get that IP to another place that was more tax favorable. And there were other schemes as well, and there continue to be other schemes you can look at, IP option arrangements, et cetera. But that was sort of the game for a while. And so people may remember, people talking a lot about Europe and the Caymans and Switzerland and Ireland and other countries. Ultimately, Trump's first administration changed that. And you mentioned GILTI in your prepared remarks. That opened a window for people to bring things back. And so if you had it here, typically you tried to move it there. And then people brought a lot of things back, or at least prepared to. The other thing that happens is, at least in our business, sometimes you're acquisitive, right? And you buy something and it has R&D outside of the US. And I can tell you in my prior company, our first R&D engine that we bought was sitting in Switzerland. And we debated, what do we do with these assets? Should we bring these things into the US? And some of the decision calculus was how much had already been invested, what cost would it take to move the thing? If it was further in development, maybe you wouldn't. If it was younger, maybe you would. But a lot of those rules have changed, and that's thanks to Trump's first administration. But ultimately, maybe just an addendum, having IP in the U.S. now means that you don't have to take your R&D and sort of shuttle it out to these holding co's around the world, and so therefore you get to have it in the U.S., which means that you get the the credits. Here from that, meaning orphan drug credit in our case, or R&D tax credits. So it's helped to simplify things, but who knows when the rules will change.
Yeah, so I did want to just a little bit for the rest of the audience. I think there's a perception that IP is also very easy to move, and I would like if you could share whether you agree with that statement and what your experience has been.
Yeah, go ahead, Anna.
No, go ahead. That's fine.
I was going to say, I think that is false. The urge of energy it takes to do the math, make the decision together with your board. A lot of times there's optics involved and other considerations beyond just the numbers. It is a ton of energy to make that decision, in my experience.
Again, many factors factor in. So you're not just looking at rules today, what rules might be later. and that later is an indeterministic amount of time. And then also how your product evolution might be, or business evolution might be. So we obviously are analytical mindset folks, so we'll go through a ton of analysis and discuss with the boards and have that conversation. But interestingly enough, a lot of the soft factors and judgments about the future start to come into play. Much like any M&A or any new market expansion that you're trying to do, where after you do all the analysis, it's not just the analysis that pushes you into the yes bucket or no bucket, but there are other soft factors that are hard to quantify. So again, we do all the analysis and then look at it. But I will tell you, good tax people are worth their weight in gold. The I cannot tell you how many times good tax people, particularly in the context of M&A, especially with IP transfer, were able to help us with cash repatriations and other things in my prior life.
And so yay to the shout out to the tax folks of the world. But I think the transfer pricing issue is also quite salient. And it, even at the stages of your organizations were years ago, were you still talking about transfer pricing, or is again that something that is now that you've developed the IP is where ends up taking more of a focus?
At least for us, it's still an important issue. And again, there are multiple shades of it, right? Is this a R&D location? Is it just a sales and service distribution location? Is it a mix of the two? So all of those factors come in. I don't think you're done with it anytime. My sense is, tax folks are in business because the rules are changing and the business needs are changing. So what may be true at a different stage or under a different tax regulation is definitely not going to stay stable. So we're continuously evaluating as those needs change and as the rules change.
Yeah, I fully agree. We think about it when we're moving our clinical trial material. We think about it when we're moving our sort of on-market commercial material. When we think about it when it's services that we're doing in cost-plus nature, you never get away from it.
Yeah, it's the number one area of controversy too. You say with the services because it is, I think, the soft stuff. There is other decisions about the location, where the IP is, and then ultimately setting up the value at which it should transfer, as well as royalty payments. There's no black and white, and I think this is where it leads to significant controversy. So now all of you out there will know to keep good documentation and be thinking about this early on rather than later on. So what other taxes? We've talked about a little bit about property taxes, right, first and foremost, but what other taxes are your organizations thinking about? Are you really worried about tariffs? I think Howard alluded to the fact that maybe it's not as big a deal as they thought it once was, but what other things have you been concerned about recently?
I'll go first. The property taxes, obviously, you talked about, but even for us, while we're a SaaS cloud software company, we do have some hardware that we developed and sell it on a subscription basis predominantly, much like Amazon sells these servers via AWS. So where those are developed, and then where the manufacturing chain traverses, i.e. from one country to another region, so coming in taxes related to tariff going out, and then coming into the US, which is where we assemble the final products today, and then sending them back out. So keeping track of all of those to see what you can get back is important. Stuff that we've alluded to before. But the one thing, maybe new one to add, is when you do sales in a foreign jurisdiction, keeping in mind the withholding taxes that might come into play is important. And yes, you're going to eventually get a credit in the US, but guess what? The dollars you were expecting from that sale to come to your bank account are not going to be that many dollars. So paying attention to that is important. Where you can double click on it is, again, hire good tax experts to see separating the contracts into different pieces to see which ones of those might be favorably treated by those international jurisdictions versus not, and how your full product solution suite might be split into different parts to take advantage of that. So another plug for the tax folks and how much they can help.
So I think we're getting close to the end of our kind of curated time, but I will put one question out on the table or thought, and I think this could probably segue into maybe some questions from the audience. But how do your organizations think about tax planning? So I think so. Tax planning, tax evasion, tax avoidance, it's a continuum. Clearly, taxes have a massive claim on firms' cash flows. But there's this notion of you should plan, There's shades of gray. But I don't think reasonable people would necessarily agree on what those boundaries are. And is this something that you guys discuss? Do you discuss with your boards or within the C-suite? And do you discuss it more? Probably over the past couple of years, where I think there's been much more focus on the obligations of business to pay their, I'll do air quote, fair share, whatever that might be.
Maybe I'll go first, Adnan. We talk about it all the time, and it is a healthy discussion with our audit committee and board when needed. I think what I'd say is you paint a spectrum, right, of where people fall out on this. I think there's some forcing mechanisms there, like when you have your auditors and they're reviewing your tax strategies, they're benchmarking you and sort of making sure you're not going too close to a guardrail. And I also think investors have a forcing mechanism too, right? If you're sticking out in one direction, they're going to call you on it, and they're not necessarily going to ask the question. They're going to say, "So when will you get in line with the rest?" Right? Like when will you fix this? So I think you're right. There is not black and white here. There's room for interpretation and creativity and structuring, and there's large dollars at risk. But I think the whole ecosystem ideally leads to reasonably good answers and not going off the rails. As you may have suggested with the word evasion.
Yeah, I would just say tax planning is a must. I think companies that have internal tax planning departments, I will candidly say, benefit more. Yes, of course, you still hire advisors for the benchmarking versus other peers, or what is the right lay of the land, or how is the legislation timing looking like. Like, here's an interesting one. Just a few days ago, we were talking about how compensation of executive officers that used to be limited as to deductibility by the companies is going deeper into the executive roster about how many people. So it's not just the neos, it's not just going to be the top couple of highly paid people, but it's going deeper. So our tax folks start asking about, in 2027, how would this be? And these are situations where you have to think about who's even going to be senior execs at that time, or what are the different compensations, and welcome to our lives. But like anything else, you just start with things that things that you can make smart guesses at, and have good advisors, internal and external.
Well, fantastic. Thank you both. I really appreciate such a fantastic discussion.
Thank you. This has been a lot of fun.
Yeah, absolutely. Thanks for having us.
So I think we should open now it up to the audience. I have, of course, a million questions I can continue to ask and hopefully get answered about what goes on with your organizations. But let's see if anybody has things that we should focus on.
Well, I've been watching the chat and the Q&A as you've been talking. And first of all, what a dynamic discussion. And we do want to get to some of these questions. Just as a reminder, if you don't see the Q&A button, it should be on the top right side of the screen. If you don't see it, you need to exit full screen mode. One of the things that's been a theme in the Q&A so far are the people who are in the younger firms trying to learn from this amazing experience that you bring. And so they've asked about if you could note a tax-related challenge that caught you off guard as one of your entities was scaling.
I'll throw one out there, but I'm going to have to be a little nebulous. My prior company, we did a deal with a large pharma, and the structure of that deal, by virtue of the way we had set ourselves up in the United States, actually it was disadvantaging us in that deal, and so we had to go and unwind something that seemed trivial, a decision we made early that was trivial, but was absolutely critical to the value creation for the company ultimately once we did this. So I think it just underscores that tax can show up in any number of different places, and the value at stake is enormous.
I think a good politician answer would be to look on the other side, like a dangerous one, like asked, is asked when you're sitting at a public company. So I will answer it from the context of M&A. Initially, when you receive the financials and you look at the company, you make your own perspectives about valuation and go into an LOI. And then further, when you get into diligence, have there been situations where we've been caught off guard by what the company shared versus our tax advisors would then come in and find how the company might have been doing something to the best of their knowledge, yet that was not right. That actually creates tax liabilities that you need to then start adding. Naturally, everybody knows about sales tax exposure and nexus presence related liabilities, but that's just the tip of the iceberg. There's plenty of other liabilities that you need to keep an eye on that will catch you off guard in M&A if, again, you don't hire the right tax diligence folks.
So I will add to this because I did practice for a number of years before I became a professor, and it was the due diligence associated with your M&A. You're so excited to do the acquisition, right? Look at the growth, that sometimes you feel as though I would say, being a tax folk, I would be treated as, oh, you're getting in the way and a nuisance. But one of the biggest issues we had with a particular M&A transaction was payroll taxes. So it turns out at ensuring that the prior owners had been appropriately reporting all necessary payroll taxes, particularly Social Security, had not been clear that they had been doing that. And even, as I said, kind of a non-income tax situation, the penalties associated with failure to pay payroll taxes are much greater than payroll taxes. And so the crossing the T's and dotting the I's on some of the other things around the M&A, I think, is very critical in the tax landscape.
So to push a little bit further on this, what sorts of signals would tell you that a company is outgrowing its existing tax approach, whether you have advisors or a fractional CFO, or you already have the function in the organization, but how do you know you've outgrown your internal capabilities or your advisory model? Are there any signals that tell you it's time to take the next step up?
I think honestly, it's thinking about people, R&D, manufacturing. If you maybe just pick those three, and they're not the end all, and just think about, okay, in terms of people, where were we located before? Where are we expanding to? It's initially for U.S. companies starts to be with more states and then international. That's one trigger. The other one is R&D. If you're really starting to develop R&D outside in other jurisdictions, then all of the things we talked about, whether they be tax credits or utilizations, those start to come in. And then the lastly, I would say, is the manufacturing one as well. So as things scale, you'll start to get a better idea. Because the one joy of being CFO, as Howard will attest to this, is the mind's always thinking about what am I not wondering or what am I not thinking about. And when your mind starts popping up too many of those questions in the tax direction, you'll know it. It's a pretty good time. Lastly, I would say your audit committee serves as a very good sounding board as well. Don't just be talking to them at audit times. Be talking to them a lot more frequently about things that are on top of your mind, and they will steer and put the right weight on your concerns and help you identify which one should rise to the important priority list.
Maybe a corollary to that is if you're growing but inorganically and you're doing a roll up and you're buying a bunch of companies, so back to M&A, you have to have tax people there, as you guys mentioned before, right? So I'd argue, in my prior existence at a startup, the tax related things came within the first months, right? Even when we were very young.
Well, Howard, let me push you. Oh, go ahead, Jennifer.
No, please go ahead. Continue with Howard, because I would have a slightly different item I'd consider.
All right, I just want to push you a little bit further on that based on another question I'm seeing in the chat. From an investor perspective, from an operating perspective, how should founders think about tax strategy as actually scaling infrastructure versus simply more of a compliance function? Right, especially in today's environment where we're all about capital efficiency and diligence readiness and exit optionality. So when does that switch happen?
Yeah, I think, whoever your investors are, financiers are, they want you to do the best things possible with their money. And I think, as Adnan and Jennifer mentioned before, and I mentioned, all those considerations come into play even when you're a startup. And so you have to have this view early on. I'd never think of it as a compliance function. I completely endorse Anand's comment that good tax people are worth their weight in gold, without a doubt. And by the way, that's true it's true for things big and small, right? It's true for a big deal where there's a lot of value at stake, and it's also true just in earnings every quarter, like hitting your EPS number. Tax can be a lever that's very helpful when you need a penny or two, right? So it's always something to have at the table, and I think that is underestimated, to be honest.
I guess I would think when you're scaling the business or as you grow, it's these location decisions. I think we brought up one of the first comments is the notion of nexus. A lot of you're excited, you're moving, you're trying to like get people on the ground or get assets on the ground, but you really need to be intentional about whether you want to put a footprint for tax purposes in that jurisdiction. And so I always get a little prickly when people go, oh, it's just a compliance burden. It's not a compliance burden. Yeah, there's paperwork that needs to be filed, but you've created real substantive economic activity in a jurisdiction that you now have to pay taxes on. And plus, you're locked in. You can't just say, oh, never mind, we didn't want to be here, without ultimately a lot of decisions to get out of there. Where are you sourcing your sales, right? If you are an organization that is ultimately B2B versus B2C, that's a very different structure on how you maybe want to create nexus. And so that's the point at which I would be really certain to have a tax individual walking me through some of these issues. Now, it doesn't necessarily have to be in-house, but I think many, particularly non-global organizations, spend far more time talking about SALT, state and local taxes, than anybody probably would want to admit, right? It's just something, because we have 50 different states plus DC, so that you're contending with long before you step into Canada or Europe and get some really exotic intellectual property regimes. By the way, states have R&D credits too. So these are types of things I would think you would want to be seeking about pretty early on, before you have a couple hundred employees.
Here's an open-ended question. I might direct it to Adnan first. How do we think about AI-based startups? Obviously, you're using lots of AI in all the things that each of you are doing. But if it's an AI-based startup, are there any new sorts of tax considerations that you're anticipating or trying to work through?
Yeah, so the valuations were quite high to speak of AI-based startups. They've started to reset a little bit over the last, call it 18 to 24 months. But like with other acquisitions, you obviously go through analysis of where the technology is located and what are the bifurcated pieces into which you can separate the different pieces, and therefore what is the schedule that you might or might not be able to take the deductions for those. Obviously, some of the laws have changed in that regard as well. Here, I would say, the primary reason for doing the acquisition is not the optimal tax planning, even whether it's a large company or a small one. So we start with the objectives of why are we doing this, or why AI is important in this particular case if it's a smaller acquisition. And those tend to be acqui-hire situations. However, while it's not the primary motivator, we go through all of that. I'm going to strongly echo Jennifer's point, who is, by the way, today allowed me to call her Jennifer instead of Professor Blouin. So I appreciate it. We definitely want to hire the right tax folks to do the diligence on the targets early on. And more important than anything, having that internal culture to leave the door open, that negative issues that come up of large magnitude should be allowed to kill the deal. This deal euphoria that Jennifer mentioned is important to always keep between some guideposts. So, like any other acquisition, long answer to your question, like any other acquisition, we do similar analysis even on these smaller situations, but keeping an eye on making sure that this is a smaller input, but it's an input that can kill the deal is important to pay attention to from the beginning.
Jennifer, anything coming at that from your perspective on the research world side?
Oh, I think AI is, it touches on so many issues. I am still standing back and thinking carefully about what this means for how we operate. The valuations, dare I say, crypto. Remember that too? Up, down, up, down. I feel there's a little bit of AI involved in there. The thing I think about, not even from an academic perspective, but more from a like transfer pricing, is this ultimately going to affect the value of this intellectual property, or more importantly, the perceived value of this IP as these businesses grow? And I think that is an area where we don't know a lot about, because those data are very idiosyncratic. Every organization has their own unique, that's why it's called intellectual property. It's, an intangible that's unique. And so I grapple with how enforcement's going to come in play, and whether or not we have good information about how the tax authorities are going to respond to this AI market that I think is here to take. But it's a technology ultimately that influences a lot of this valuation.
So there's a very specific question that was submitted, and then I think I'll give a more general form of it. The specific question is, please remind us of the strategy for choosing the form of incorporation, because that's going to relate to capital gains taxes when you exit. But the broader form of that question is, what are the tax issues that most founders wind up overlooking that can significantly affect their exit outcomes and their personal wealth?
Jennifer, you should take that one.
Oh, can I have this one? Thank you. I mean, this is, tax 101 is, how do you organize? That's really what this question is asking. How should you establish yourself when you first start? So there's different ways to start, though. I have an idea that I developed in my garage, and I am thinking more critically at that point in time, probably about liability protection. And then as I scale up, there's reasons as to why I would want to be an entity that is transparent, or a pass-through, as we would say. But then Howard has mentioned that he they created businesses by essentially aggregation, by rolling them up and putting them together. So in that type of structure, you don't have a choice to necessarily be these conduit or tax efficient structures or tax transparent structures, because you have real corporate entities that you're coming together. So it's a hard question, because to me it's a life cycle choice. At what point are you going to exit? Is it you intend to innovate and be acquired? That's a very different thought process than, I am going to go public with this organization. There are incentives that we have in the United States for like the qualifying small business stock that gives some very, very preferential rates if you choose to be in corporate solution. But again, I think, as we've been discussing here, there's a number of non-tax issues or soft issues that probably need to be addressed before you can answer that question definitively. So students hate this answer I give all the time: it depends.
That's a professor answer for sure, but it really does depend. So there was some talk about the tax experts being worth their weight in gold. Now, startups have clear financial runways. They have to be mindful of every dollar that they're spending. So are there ways to find these sorts of experts without paying top dollar? How can startups even begin to assess potential tax professionals?
I can give you an N-of-1 experience here, but I think here's the evolution that I had at Veer, which was initially we would outsource it all, right? And we tried our best to understand what was coming in, right? But from a non-learned perspective, that interface sometimes gets really complicated and confusing. So our next step was not to hire a purely tax person, but to hire someone who was hybrid. We actually hired them out of one of the big four, and they had experience with tax as well as accounting. And so they became a bit of the translator for us to the external support. And then ultimately, you evolve from there to hiring in like a head of tax and a tax team, et cetera. So that's one path. I'm sure there's 35 variants on that path.
Analogous to yours, we ended up hiring somebody who was tax and treasury. And again, this is a person that we thought could start to do a lot of the stuff internally that we had been growing and spending a lot with advisors. So moving some of that dollars helps you think about from a startup's perspective, or even a cash management perspective, as to when is the right time to offset some of the costs that you might have of a full-time person by doing some of the stuff that you were outsourcing before inside.
Well, can I ask kind of a follow-up question to you too? So going through a startup phase, how'd you find those people? Was it word of mouth or is it the guy or gal that you knew? I mean, I get asked, frankly, all the time by students is, do you have somebody you could recommend? And or how do I find somebody? And ironically, I don't know the answer to that question. So I'd be curious about both of your experiences.
I took two paths. One was through our auditor, and the other was through our VC, because they've seen startup, after startup. So those were the two paths I approached. But I did not use a headhunter. If that was the question behind the question.
A headhunter we did not use either. Again, for cost saving, the reason you're trying to hire a person in house is to try to save some money. So, look, for us, a couple of paths, similar to how folks will hire people in the accounting departments from Big Fours. You can ask your tax advisors for folks that may be doing that as a services profession but want to move into industry. That's one, and it turned out really good. When we were interviewing a bunch of people. Second path is, of course, asking your audit committee members, a lot of whom have been ex-CFOs and have their own network of tax people. And between those two, we were able to get a decent set of resumes. But these folks are rare. That's the one thing I will say. It's hard to find somebody who can understand your technology, knows the tax laws, and is aligned with the stage of growth that was mentioned for the company.
Well, we're getting short on time. I want to hit one more question. Even though we're coming to you, Jennifer and I are coming to you from snowy Philadelphia, both of our panelists are coming in from the West Coast where they are I believe, based. Can you go a little bit deeper into some of the tax incentives or challenges that would be useful for companies that are thinking about California in particular, being Wharton, San Francisco all the way? We want to make sure we cater to that community as well.
Sure. So Jennifer mentioned some of the states being favorable from a tax perspective. It's amazing to me how the second most important line every time we're looking at tax credits beyond the federal NOLs a company might have, or the California specific credits and the R&D credits. And it's favorable, of course, when you're doing this stuff, but it's also something to consider when you're alternatively thinking about putting something somewhere else. For us, we have publicly talked about how we have grown the team in Canada. And depending on where in Canada you put the teams and the folks and the type of work you do, the Canadian SHRED credits, which are research and development credits, I think are fantastic for companies to look into as well. So those would be two thoughts, California specific and also outside.
Yeah, this one I'm smiling about. Every state has pros and cons, and you got to think about where you're going to access your talent. And part of Nexus, I think we've seen it since COVID, is that people a little bit, and at least in some industries, abandon the people have to be right here. I'll just go and I'll find the best talent. But by doing that, you can find yourself in 40 plus states pretty quickly. And that was the case of our company. I also have memory, and maybe I'm getting this wrong, but I have a memory of my prior company. We chose a spot that was just outside of the San Francisco line, or maybe it was just inside of it. And there was a tax, an IPO tax that they were considering doing, which would, take a reasonably healthy chunk of what you could raise in an IPO. And who knew that was going to pop up, right? So there's always some new surprise where governments who have an incentive to try to find ways to bring in more revenues will get creative and dip into the businesses that are in their jurisdiction.
Well, hopefully neither of you lose 5% of all your assets for the billionaires tax here in the near future. Well, or maybe I hope you will be in a situation where you're contemplating losing 5% of your wealth to the billionaires tax. So.
Well, let me just say wow, and thank you to Jennifer, to Adnan, to Howard for a really thought-provoking discussion. I mean, my takeaway is that this is scale school at its best. There are so many tax-specific issues that are so incredibly important for scaling companies, and we need the combination of expertise that's informed in the classroom and by research, like Jennifer brings, and the hard-won years of learning and experience from our alumni. And this discussion is better, and scale school is as good as it is because of the mix of these perspectives. So we're really grateful for all of of you coming together today and everyone in the community joining us virtually today. I want to take a quick moment to thank our behind the scenes team, Lifelong Learning and Venture Lab and IT. We've put a lot of our folks on the ground to make this happen virtually. And I'd like you all to save the date for our next Scale School event, which is Wednesday, April 22nd. This one will